So financial freedom is the goal, right? And your preference to do so or to reach this goal is through rental real estate. Okay. So in order to effectively reach this goal, one of the most effective ways to assess this goal is going to be to reverse engineer getting to that goal. So for this video, we're going to use some generic numbers. And what I'm going to do is help you reverse engineer from a borrowing capacity, from a financial perspective, where you need to be in order to successfully reach this assumed number. And of course, once we get through this presentation, you guys can plug in your own numbers around this concept to understand where your financials need to be, how much you're going to need to borrow in order to reach that magical financial freedom number. We're going to discuss all of that in this video. This is JP from Blueprint for Prosperity, helping you to increase your net worth through relationship banking, maximizing your borrowing capacity, proper use of life insurance, and the ownership of real estate. I want you to like this video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity. So many of us have been allured by this concept of financial freedom. And one of the most attractive vehicles to reaching this, and one of the most promoted vehicles, is through rental real estate, buying whole real estate. So what I want to discuss in this video is another way for you to look at how to reach your financial goals through rental real estate from a financing point of view, and where your income needs to be and where your credit needs to be in order to best put yourself in position to reach this goal. In today's example, we're going to use 10 properties worth $120,000 per property, bringing in $1,200 a month. That's the 1% rule, which not every investor follows, but it is a real thing where investors are looking for properties that is going to bring in 1% per month of its total value. So if the property is $100,000, it's going to bring in $1,200 a month at 1%. So if we're looking at this from a financial freedom perspective, then that means if you have 10 properties that are worth $120,000 and they're bringing in $1,200 a month, that means you have a $1.2 million portfolio bringing in $12,000 in gross revenue per month. Not too bad. So what type of financials do you need in order to be able to borrow? How much do you need to borrow to be able to get your hands on a $1.2 million portfolio to get that $12,000 per month? Well, one of the most important metrics that you need to understand is going to be down payment requirements, and you're also going to need a DTI requirement. The reason we're sticking to 10 properties is because conventional loan limits when it comes to investor loans is limited to 10. So that means anything beyond 10, you're going to have to use creative financing or you're going to have to buy through a business entity. You're not going to be able to have more than 10 loans in your names as an investor with rental real estate. So that's why we're using 10. The second reason we're using 10 properties is because for many of you, 10 properties bringing in $12,000 a month with some decent tax strategy and tax planning, you guys will live a very comfortable life. That's $144,000 a year. It's not the richest person in the world, but many of you can live a very comfortable life and probably never have to work again if that was coming in every month. So that's what we're going to stick to in this video. So what are down payment requirements on most standard investor loans? Now, mind you, we're looking at this from a perspective of going to your conventional bank or conventional lender. We're not talking creative financing and all of those hoops and hurdles. We're literally just talking about being a working class individual, somebody with a 9-to-5 job, or maybe you're a small business owner and you're looking to go through the conventional route of financing, acquiring a property at a time. So conventional lenders are going to be looking for somewhere between 20 and 30% down per property. So to put that in perspective, if you're looking at $100,000 property or $120,000 in this particular scenario, then 20% is going to be about 24, right? Yeah, $24,000, right? So if you're looking at 30%, you'll be looking at $36,000. That's per property you're going to need to put down in order to meet the requirement for down payment requirements. So you can do the math on that. That basically means that you're going to need about $240,000 to $360,000 in down payment money over the course of this strategy in order to take down these properties. On the other side of that, that means that if you're at the 20 to 30% threshold, that you're going to be borrowing somewhere in the proximity of $800 to $900,000+ in order to finance these properties after the down payment has been accounted for. Excuse me. So after the down payment has been accounted for, you're going to need somewhere in the proximity of $800 plus to $900,000+ you're going to need to be able to finance to take down this property for the entire $1.2 million portfolio we're talking about. So what does reverse engineering look like for you? How do you afford basically somewhere between $70,000 and $80,000 per property, or again, somewhere in the proximity of $800,000 or more borrowing capacity? You're going to need to have a very healthy DTI, and you're going to need to have very strong credit. The debt to income ratios on average for conventional loans, when it comes to investment loans, is going to be somewhere between 36 and 50%. 36 and 45 is a lot more realistic. So that basically means DTI is debt to income ratio. That is going to be your monthly expenses reported on your credit report in most cases versus your gross monthly income. So if you have $2,000 in monthly expenses, $4,000 in gross monthly income, that means you have a 50% DTI, which is pretty high. Lenders are looking for somewhere at between 36 and 45. And of course, if you're lower than 36, it's just more attractive. You look less risky. The reason for this is because they want to know that you can easily handle the debt on a monthly basis, the payments on the debt that they're going to be lending you on a monthly basis easily. And if you have more discretionary income, you have more excess income, then that means that there's a likelihood you're going to be a more stable borrower. So with the understanding of how much money you're going to need down and the understanding of somewhere where your income is going to need to be, right? Because now we know if we're looking to borrow $100,000 that we need, and those payments are breaking out over a 30-year time frame, we'll just keep it fixed and say 30 years, then we need to be making about 3 times the monthly mortgage payment, roughly, somewhere between 2 and 3 times that monthly note. So that means on a per property basis that you don't need to be making a heck of a lot of money to take these properties down. You are going to need a significant amount of down payment, but you can come up with that through savings or other creative means. And on the flip side of it, as your income starts to stabilize on the property, eventually the rental income can start to count towards your income as well. And this is where the exponential growth can start, because you're no longer going to be relying on your W-2 income or your business income. The property income is starting to play into this equation and compound upon itself. So I wanted to put this on you guys' minds. You're going to need to have a stable, strong income to get this snowball rolling. And then you're going to want to have strong personal credit so you can get the lowest interest rate possible, which affects your monthly payment. Again, going back to your DTI, debt to income requirements. If that monthly payment is significantly higher because your credit was poor, and now that payment is more inflated, this is less property that you can take down. So having a strong credit score lowers the interest rate, which lowers the monthly payment, which lowers, that means you have a lesser demand for your monthly income in order to take down the property that you need to take down in order to reach your financial freedom goal. So this is how you need to start structuring your plans around financial freedom if you're focused on rental real estate. You need to be figuring out and reverse engineering the size of the portfolio you need, the returns that you're expecting from that portfolio. You need to go in as the investor thinking, what am I looking for as far as income from these properties before you take them down? And that's why I use the 1% rule in this particular case, because that is a strategy that many cash flow focused investors are using. They're looking for properties that if it costs them $150,000, that it's going to bring in $1,500 a month. And the math goes on from there. You need to understand that strategy for yourself. Once you understand that, you know the size of the portfolio, you know the gross monthly revenue coming in, you can reverse engineer where do I need to be financially in order to build up that portfolio so I can get that gross monthly income, start to live the life that I've been daydreaming about. So I want you to leave a comment down below. Let me know your thoughts. We can go into greater detail. We're going to shoot more content around this, but I want you guys to give me your feedback so I can know more where to answer your questions and help give more guidance around this topic. This is JP checking out. I appreciated bringing you guys this content. I hope you enjoyed. I want you to stay focused, stay in motion. See y'all in the next one.